Hi, this is Jack Schwager. In this video, we're going to take a look at applying the Jack Schwager indicators to stocks. Now, there are several key differences between stocks and other markets. First, and most important perhaps, in contrast to futures or FX, stocks have a very strong long-term secular uptrend, whereas FX or commodities tend to move over time in very, very broad trading ranges. Now, there may be significant trends within those trading ranges, but essentially, especially once prices are adjusted for gaps and rollovers, prices tend to move in a very broad sideways pattern. Stocks, though, can see extremely large up moves over time and definitely exhibit this directional bias. That implies that there is an inherent disadvantage to being short stocks over, again, very broad periods of time. Second, shorting some stocks may be difficult or even impossible. You can't borrow stocks to sell in some cases, or there may be other impediments. But unlike futures or FX, where one can just as easily go short or long, the same is not necessarily true for stocks. And third, some traders may, either for the reasons I've just indicated or other reasons, only want to trade stocks from the long side. So for all these reasons, we saw a need to include the option to trade these indicators only from the long side. So you will find within the TradeShark software the option to trade the indicators with a long-only bias. Namely, you'd be long when the indicator is long, neutral when it's neutral, and neutral as well when the indicator is short. Now let's take a look at a couple of examples. So first, let's take a look at Disney. In this case, we have a stock which basically, during the period we're looking at, does exhibit a significant uptrend all the way through, with one major correction, many corrections, but one large one. And we're using, in this case, the simple trend weight with a zero line. So assuming it's bullish when the trend weight is positive and bearish when it's negative. As you can see, you're basically long for the entire period, with this exception where you get a sell signal here and basically out here for a loss during this particular period. Now, as I said, there is the option to trade stocks only. You can actually apply the same option to any markets, but we're assuming one would only use it for the stock market. You can go to Properties and then go to Formula and check off this long only box right here and hit OK. And now you can see what essentially happens when you have this option selected. If you get a net short situation, it'll basically show it as neutral. So you would here, instead of being short, you'd basically just be out and you'd resume the long position here. So that's one example. Now let's take a look at another example, this time for a stock which has more of a trading range pattern, finishing higher than where it started, but still in a trading range pattern. This time for a change, we're using the trend weight, but with a 50 threshold, namely you're going to be long above plus 50, short below minus 50, and neutral in the middle. And you can see the pattern that we have under the normal application. You do get two shorts here, one here, and a longer lasting one here. Now, if we again do the same thing, we go to Properties and go to Formula and select the long only option, hit OK. Now you will see the prior cells turn into neutral. And so essentially what we have in this particular case is for almost this entire period from here through here, you're basically out of the market with one short-lived buy right here. So that's the way applying this long-only option would change the behavior of the indicators and the signals which they provide. In trading stocks with the long-only option, I would also note that you could actually set the threshold to a negative number. Now, what does this mean and why would you do that? Well, essentially, it means that you would only be out of the market when the, say, trend weight fell below a certain negative number. And the reason you would do that is because you might only want to restrict yourself from holding a long position when you have a true extreme negative situation, not just for a moderate negative reading. So for example, in the accompanying chart, we look at Oracle again, and then this time, instead of having a threshold of plus 50 as the division line between being long and out of the market, we now use a very loose restriction for staying with the stock, namely a threshold level of minus 80, which means you'd be long as the trend weight is above minus 80, and out only if it is below that level. And you can see in this particular case that we're out just for that extreme period between here and here, and essentially long throughout the rest of the time. The long-only option with a negative threshold level is actually a good alternative to a buy and hold position. Similar to a buy and hold, it will be long under most circumstances, but with the advantage of signaling exits when there are true sustained major bear trends in a given stock. Currently, there are some conflicting considerations, and to place currently into context, this is being recorded in late March 2015. Now, although over long periods of time there's a definite strong tendency for stock prices to have an upward bias on balance, at present we are at a point that has just experienced a strong bull market for 6 years with stock prices at all-time highs. So ironically, at this point, we may be in a situation where a long-short approach may actually be preferable. So since we have these conflicting considerations, a secular uptrend in stocks versus a very, very extended bull market, it is really a matter of personal choice whether it's best to use the indicators in long-only mode or in long-short mode at this point. One thing that can be said, though, is that if we do see a significant retracement develop at some point in the future, following such a retracement, the long-only option would seem to be preferable to a long-short application. One question to consider is, given the tendency for stocks on balance to witness a strong secular uptrend over long periods of time, would it perhaps not be better to simply use a buy and hold strategy in stocks rather than a long-only indicator to trade stocks? Well, there are two important considerations in answer to this question. First, many investors will experience worse outcomes with buy and hold than a long-only indicator, even if buy and hold has a higher return over the long run. Why? Because many investors won't be able to stay with their positions during the really big breaks, such as those that occurred during 2008 and over different times for different stocks. And in such circumstances, investors will have a tendency to get out of their positions and never realize the subsequent recovery. Remember, the news will always sound most bearish when the market stock is near a low, and you may well find yourself getting out of stocks that you thought you would hold. You will have much better chance of realizing long-term returns if you can sidestep the big retracements, and using a long-only indicator would be one way of often being able to achieve this particular goal. Second, rather than hold a constant long-only portfolio, you may be able to do much better by allocating the same money only to those stocks in the portfolio that are currently in long mode. So for example, if you have a 20 stock portfolio, rather than place 5% in each stock, it may be a much better strategy to divide the same money evenly, but only to those stocks that are at the present point in time in a long mode given the indicator. And of course, that particular set of stocks will change as the indicators change, but the point is that rather than invest in all stocks in a buy and hold strategy, selecting only those stocks that are in buy mode and allocating the same money to those can often achieve a much better outcome. So this completes our discussion of applying the Schwager indicators to the stock market. This has been Jack Schwager, and we will continue this series of videos with video 8 which will explain how to derive some of the templates we have used in this series.